Did you know that 78% of Americans live paycheck to paycheck? This means that if you're in high school, there is a 4 out of 5 chance that your parents are living like this. My goal is to make our generation financially literate. You may not think that being financially smart is a big deal, but the number 3 leading cause for bankruptcy inside of the US is poor financial decisions. All right, let's have a quick look at what we're covering today. First, we've got money comprehension and goals, where I'll talk about understanding money and setting financial goals that actually make sense to you. Then we'll move into budgeting, because let's be honest, knowing how to make your money last is a very valuable skill. After that, we've got banking, which is going to cover the basics of managing a bank account, saving money, and avoiding unnecessary fees. After that, we'll go into credit and debit. This stuff can either set you up for success or cause you major headaches if you're not careful. And finally, we'll wrap things up with implementation, where we'll put everything together so you can implement our ideas into your real life. By the end of this, you'll have a great foundation to make smarter money moves. Let's go. You should be viewing money as a tool, not just something to spend or save mindlessly. The key to financial success is making your money work for you. But what does this actually mean? It means putting your money into things that grow in value over time, like investments, education, or even a small business or side hustle. Think about it this way. Every dollar that you leave sitting in a checking account doing nothing is a missed opportunity. This is what's called opportunity cost. If you put the same dollar in a high yield savings account, in the stock market, or even into a side hustle, it has the potential to grow and create even more money. For example, let's say you have $1,000. If you leave it just sitting in a regular checking account, it earns nothing. But if you invest it in the stock market with an average return of 8% per year in 10 years, that $1,000 could become over $2,100 without you doing anything extra. The point is, money isn't just for spending. It's a powerful tool, and when used correctly, it can open opportunities, create wealth, and set you up for financial freedom. The earlier you start thinking this way, the better you'll be in the long run. Financial decisions are a lifelong journey. Every choice that you make with your money today can impact your future, whether it's saving, investing, or even how you spend your money. That's why planning ahead is important. Money gives you freedom and flexibility. It allows you to make choices based on what's best for you rather than being forced into financial decisions because of limitations. Whether that means having the ability to travel, retire early, or handle unexpected expenses without stress, your financial choices today shape those opportunities. One key part of financial decision making is managing risk. This means protecting your wealth from unexpected events like medical emergencies, job losses, or car repairs. You might not know this, but medical expenses are the number 1 leading cause for bankruptcy in the US, and the number 3 cause is poor financial decisions. One way to make sure that you stay safe from these is through insurance. While it might seem like an extra cost, it actually prevents bigger financial problems down the road. But financial planning isn't something about just making money. It's about reducing the stress and improving your quality of life. When you have a solid financial plan in place, you don't have to panic about unexpected expenses. You'll feel confident in knowing that your money is working for you and that you have flexibility to handle life's challenges. At the end of the day, being financially prepared means being in control, so you can focus on what truly matters to you. All right, next up, you have budgeting. Whether you're an adult or teen, managing your money wise is crucial to your financial success. Here's how you can do it effectively. First up, for adults, we have the 50-30-20 budgeting rule. This is a simple but powerful way to allocate your income. 50% of your income should go to your needs. This is things like rent, utilities, and groceries. 30% is for wants. This could be things for like dining out, entertainment, and whatever hobbies you have. And then the last 20% should either be used to save up or to pay off your debt. This helps you balance your spending and saving without feeling super overwhelmed. Now for teens, we recommend the 20-20-60 approach. 20% of your income should go into your savings or checking account, one of your either 2 bank accounts. Another 20% should be used for your wants, which this can be used for spending money on things like clothing, hanging out with your friends, and food. and the remaining 60% should go into your investments. I personally invest in the stock market and more specifically mutual funds. Adults, make sure not to forget about your emergency fund. Life can be unpredictable, and having 3 to 6 months worth of expenses saved up could be a lifesaver. Finally, no matter your age, you should be tracking your expenses. You can use things like Excel or Google Sheets to monitor where your money is going. This is to make sure that you are not overspending. Okay, now I'll be breaking down 2 real-life examples of how budgeting works. First, I'll start with a teenager's summer income. To start off with this, I'd put away 60% of your money into stocks right away. This is what I did last summer. I put mine personally into a mutual fund with the ticker SPY, which tracks the S&P 500. This ticker usually goes up 10% every year. This is not financial advice. I'm not telling you guys to invest in this. Do not come at me if you lose money or something like that. And from then on, I'd put 20% into your wants. For me, this would look like 12.5% goes into clothes or other wants. For me, I'm a big clothes guy. Then 6.5% I would put into hangouts with my friends, like movies and food. Sometimes we'll go out into the city and do things like that. Then 1% into gambling. Most of the time, I'll just claim the free rewards on the apps. But I mean, if you want to go bigger on that, be my guest. And the last 20%, I put in my bank into a savings account to save for the rest of the time. Let's now talk about the world of banking. Understanding the differences between checking and savings accounts can help you make smarter financial decisions. Here's what you'll need to know. First, let's talk about checking accounts. These accounts are great for everyday use because they offer very easy access to cash and instant withdrawals. You can use them for paying bills, shopping, and more. However, there's a downside. Money in a checking account doesn't grow. In fact, due to inflation, you might even lose value over time. So while checking accounts are convenient, they're not ideal for long-term savings. Now, let's look at savings accounts. These accounts are designed to help your money grow over time with consistent growth through interest. They're also simple to use, making them a great option for building an emergency fund or saving for future goals. However, savings accounts have their limitations too. There are often better alternatives for growth, like investments, and you typically don't get a debit card with a savings account, which means accessing your money isn't as quick as a checking account. In summary, checking accounts are perfect for daily transactions, while savings accounts are better for growing your money over time. Depending on your financial goals, you might want to use both to get the best side of both worlds. Let's keep going forward and check out more bank accounts. Now, let's explore some other important pieces of financial planning that can help you manage your money more effectively. First up is the emergency fund. For adults, a high-yield savings account, which down there in the table it's called HYSA, is a great place to keep this fund. An emergency fund is crucial because it provides a financial safety net for unexpected expenses. Remember, saving your money is very important and beneficial to your financial health. Next, let's talk about different types of accounts that you can use to grow your savings. Besides the standard savings account, like we talked about before, there are certificates of deposit and money market accounts. Each of these has their own features and benefits. High-yield savings accounts are ideal for short-term savings into your emergency fund. They offer high interest rates, which are typically around 4-5%, and provide easy but limited access to your money. The balance requirements are usually low to none. Money market accounts offer higher savings with some checking features. They often have very high interest rates, though these can be tiered based off your balance. Access to your money is easier than a high-yield savings account, but there are some limits. The balance requirements usually are higher than high-yield savings accounts. Next, we have the certificates of deposit, which are the best for long-term savings. They offer the highest fixed interest rates, but your money is locked for a certain period of time, ranging from months to years. This makes certificates of deposits less flexible but great for growing your savings over time. In summary, choosing the right type of account depends on your financial goals and how quickly you need access to your money. Next up, we have credit. Credit plays a large role in your financial future. To dumb it down, credit is just borrowed money, like loans or credit cards, that you agree to pay back. Your credit score determines the interest rates you get on loans and whether you qualify for big purchases like a car or a house. Managing credit wisely can help you build wealth, but if it's misused, it can trap you in a cycle of debt. That's why understanding the 5 key factors that making up your credit score is very important. First up is payment history. This makes up 35% of your credit score. This is the biggest factor. Always pay your bills on time because just one missed payment can drop your credit score significantly. Next up is credit utilization. This is how much of your credit you're using. You should keep your balances below 30% of your credit limit each cycle, ideally even lower. Next up, there's credit history length, which is 15%. The longer you've had credit, the better. That's why opening a credit card early and keeping it open can help. Next up, there's credit mix, which is 10%. Lenders like to see that you can manage different types of credit, like a car loan or a student loan or a credit card. Then lastly, there's new credit. Applying for too many credit accounts at once can hurt your credit score, so make sure to be strategic when you apply. Your credit score impacts more than just loans. It can affect your ability to rent an apartment, get a job, or even start a business. By building good credit habits now, you're setting yourself up for financial success in the future. Now we have debt. Debt is often seen as a bad thing, but it's not always negative. There's something called good debt, which includes student loans, mortgages, and business loans. These things can help you build wealth or increase your earning potential. However, debt can be dangerous if it's mismanaged. That's why it's important to avoid taking out loans unless it's absolutely necessary. If you do need to borrow money, make sure you have a plan to pay it off. One of the biggest risks with debt is the debt cycle. This happens when people take up too much debt, struggle to make payments, and end up paying more in interest. The best way to avoid this is to pay off debt as early as possible and never miss a payment. Missing payments can lead to higher fees and a lower credit score, making future borrowing even more expensive. By using debt wisely and staying disciplined with repayment, you can take advantage of the benefits without falling into financial trouble. All right, as we wrap it up, let's take a moment to review the key points that we've covered today. First, we've worked on developing a basic understanding of the most important financial terms, which sets a solid foundation for making informed decisions about money. We've also provided some in-depth resources back on the server, including quizzes that will help you dive deeper into these concepts. I encourage you to take the quiz and continue expanding your financial knowledge. The quiz is not very difficult. It has, 7 questions, and it just covers some basic terms that we've learned today and will help you judge yourself on how well you've been doing listening to these lessons. Looking ahead, the next step in your financial journey is implementation. If it applies to you, consider taking actions like opening a Robinhood account, opening your bank accounts, getting added to your parents' credit card, and of course, starting to budget. These actions can help you apply everything you've learned and begin managing your finances effectively. Lastly, remember to do more research. There's always more to learn in the world of finance, and continuing to educate yourself is key to long-term financial success. Great job today. Let's keep up the momentum.